Welcome back, everyone, to another great real estate investing episode. I'm Siwin Yi. Of course, my co-host is Julie. How are you,
Hi.
Julie?
Good morning, fine, Siri. How are you today?
Fine, thank you. Julie is my partner in crime. Yeah, so she's one of the great member of our investment network, and she's always available to discuss real estate investment strategies and
Mm,
housing market and what have you. And Julie's pretty much represent our investor. She's putting
mm,
herself in her shoes. Now, when we present on whatever topic, you will put yourself in your shoes as a newbie investor or
Great.
starting. What are you thinking when you learn this kind of real estate education?
Absolutely.
Yeah. So thank you for.
Thank you. Thank you for having me.
Yeah. So without further ado, let me share my screen and let's talk about this particular topic. The topic is where is the best multi-unit trophy market?
Wow. That's
Wow.
saying a lot right there.
That's a lot. And
Trophy market.
that's right. This is it. You decide for yourself. We
Mhm.
can give you all the data, all the trends, all the information. Then you will decide at the end of this podcast whether this is the best multi-unit quote trophy end quote market. So without further ado, let's dive in. So we are talking here, the fifth largest metropolitan statistical area in Texas, the fastest growing county in the entire state of Texas. This county in South Texas, Julie,
Mhm.
is growing faster than Houston Metro, than Dallas Metroplex,
Mm,
than Austin High Tech Hub, and then San Antonio up and coming metro as well. So
okay.
a lot of people don't know that, but now look at the data. We're not,
Mhm.
well, fifth largest county in huge, large state of Texas. We know Texas is growing very fast for many years now, very consistently. So I'm
Mhm.
gonna all this data below. You read it on your own.
Right.
What's going on? Okay, so you can pause the slideshow when you replay this podcast on your own. Then you realize these amazing data points that validate what's going on in this particular market right here,
Mhm.
in Texas, right by the Mexican border, southeastern part of Texas, like 50 miles, 70 miles away from the Gulf Coast, which is around here.
Okay.
Yeah, which is mainly McAllen, Edinburgh, and Mission, and few other sub cities located all across this area.
Okay.
Yep. So McAllen, Edinburgh, Mission, already the fifth largest metropolitan statistical area in
Mhm.
Texas. Uh,
Mm,
as you can see, all the data, again, we're not going to discuss all this detailed data.
mhm,
You can do some further research on your own, you guys watching this. So
mhm,
this Hidalgo County, okay,
mhm.
fastest, faster growing than 95% of all the counties in the state of Texas. Is it amazing?
That is amazing. Wow.
Yeah. Texas overall will continue to grow all the major metros, which
Yeah.
we discussed. The suburban emerging growth is still happening to all the other metros that we discussed. As you can see right here, Dallas, Houston, San Antonio, Austin,
Right.
then comes South,
Mhm.
but it's up and coming. And the prices
Mhm.
right now here in South Texas is very low
Right.
compared to the other areas of Texas. So that is a great trending point.
That is. That really is.
Yeah, Julie, you and I talked about this a number of times recently.
Right.
We-
Mhm.
in a lot of videos, this part of the country,
Mhm.
this part of Texas. Look, not too many emerging market. You see such a interesting growth. This hospitals is is not
Wow.
it's brand new. It's only been recently built. Yeah,
Okay.
Julie, when you enter a particular metro, particular city, when everything is all kind of new,
Mhm.
you know something's happening, right?
That's true. Very true. Yes.
Why would multiple hospitals in a particular area
Right.
continue to be built? Why more constructions? Builders and developers
Mhm.
are building new home, new multi units. Why retail stores and companies are moving in the area? Right?
Right.
These are just obvious trends of a growing
Mhm.
market, right?
That's a very good point. Yeah. Because they're expecting more people. the hospitals, the malls, the shopping, grocery stores, whatever. If you're having a higher demand of people, then you've got to build to accommodate.
Yeah, you look at all those people that work in all these various medical centers.
Mm-hmm.
The heart and cancer has the South Texas health system, the regional medical centers, the teaching hospitals, the top hospital where they training new doctors and new nurses and new medical professionals with young people that when they graduate, they're gonna enter the workforce. And because South Texas, the cost of living as of right now is still lower than other part of Texas. I don't think if I were a young person graduate from a medical school
Mm-hmm.
in this area, if I were a nurse or any medical professional just graduating, why would I go to other part of Texas or other part of the US when the cost of living as of right now
Mm-hmm.
is still very low, right?
That's interesting. Yeah, that is definitely great. Like you said, if you were younger, just out of college, or you've got your degree, that would be a great place to go.
Yeah.
Yeah, because cost of living, especially where we live here in California, it's so ridiculously high.
Yeah.
You know.
That's why a lot of people are migrating away from California to go to
Mhm.
other areas in other part of the US. And,
Right.
and Texas are the recipient of in-migration,
Uh-huh.
continue to do so. When you have an influx of young people graduating, highly educated workforce, not only in the medical field, we'll talk about they can they don't have the most of them they don't have the money to buy their own houses, so they
Mhm.
could be renting for a while, right? That us as a real investors is prime opportunity. Don't you agree for us to buy rental properties in this area?
Mhm. Absolutely.
But
Absolutely.
take advantage of this large rental pool of,
Mhm.
of tenants that could occupy your property, right?
Absolutely. I was even thinking with the influx of the the medical facilities, like we've talked about previous, it leaves an opportunity not just for long-term investments, but even like midterm and short-term, if that's something that
Right.
people have an interest in.
Yeah, it's coming around. Midterm rental asset space is coming in the next few years.
Mhm.
Maybe not right
Mhm.
now. The short-term rental, not right now, is not robust yet in South
Mhm.
Texas. But who knows? This area, Hidalgo County, is only like 50 miles away from the coast, South Padre Island,
Mhm.
which is a vacation destination spot.
Mhm.
Anyway, furthermore, there's more. Wait, there's more. So yeah, because when you have top-rated colleges and universities and two-year colleges and
Mhm.
trade schools
Right.
also,
Mhm.
or in this particular region, look at that. Look at so many
Right.
possibilities. Those professors, those college instructors, the students, and the support staff, all these local colleges in South Texas.
Mhm.
The University of Texas at Hidalgo County, there are 30,000 students, part of the University of Texas system, yeah, in which the main campus is in Austin, but there are satellite campuses all over the
Mhm.
Texas. And
Mhm.
here in South Texas are no different. So this huge University of Texas at Hidalgo County
Right.
is a main hub for students. But then you have supporting colleges, all the colleges, healthcare center, two-year colleges, trade schools. Those trade schools in local area, they can provide
Mhm.
so many jobs, mechanics or medical technicians or manufacturing. So this county is producing so many young people. They're gonna hit the workforce. They need a place to rent. So it's
Sure.
right.
It makes sense. It makes a lot of sense. Yeah. Just a lot of opportunity for potential tenants or potential renters in that area.
Exactly. And we'll talk more about that.
Mhm.
Again, there's a little bit of medical tech, medical high tech, if you will. Among the growth in the South Texas, you're gonna have data centers, you're gonna have
Mhm.
fulfillment, you could have medical offices, you could have life science. All these are robust, futuristic medical technological growth sector in a medical field, right?
Right. Absolutely.
Yeah, that's amazing. You wouldn't think
It
that.
is amazing.
Furthermore, I just produced an article by the U.S. Bureau of Labor Statistics. I know it's not very
Mhm.
clear.
Mhm.
Now,
Mhm.
mentioned in a recent article, the top 10 markets with the most recent STEM job
Mhm.
growth. Now,
Right.
STEM means engineering, right? Computer science, technology.
Mathematics.
Yeah, STEM is basically Silicon Valley, San Jose, where I live in. Yeah,
Absolutely.
that's a STEM, that's a high tech growth. That's a Silicon Valley. But STEM
Mhm.
growth is high tech, is up and coming, is futuristic. And
Right.
with that said, McAllen, South Edinburgh, and Mission, which is in South Texas, Hidalgo County, is rated number 5 in the top 10 markets for most STEM job growth. It's amazing.
Wow. That's exciting news.
Yeah, high tech.
Mhm.
High tech is entering this market. So we can see high tech professionals, young professionals moving into South Texas market for the
Right.
future.
That makes sense. Mhm.
And engineering graduates, young graduates, computer science and engineering, not only locally, but even other part of Texas, because the low cost of living, they could come over here. Those highly educated young millennial workforce, they could migrate into South Texas to take advantage of job opportunities, low cost of living, high quality of living, and be a part of the growth of this area. Isn't it amazing?
Right. That is amazing. That's awesome.
Now, this article only goes up to 2020.
Oh, okay.
People don't know that Hidalgo County, which is South Texas,
Mhm.
years ago, it has grown to 1 million people. And
Wow.
you see the almost like vertical population growth. That's 2020. I want to get an update article for 2024, but we're not going
Sure.
to see that until the
Mhm.
updated data. We're not going to see that until early part of next year. For the 4 years since 2020, how many more people? More than 1 million. It's more.
Right.
See the vertical growth? It's just when you
Yeah. It's skyrocketing. Yeah.
skyrocketing.
Mhm.
If these trends or this data, these trends are so obvious, it just look, this market, this South Texas market is undiscovered. It's still at the beginning stage.
Mhm.
The national media so far have not caught up to it, which is good. Julie, it's good for who?
It's for us.
Good for us real estate investors. Why is it good for us?
Absolutely.
Why is it good for us and real estate investors?
Oh my gosh. Still, I mean, it's a great time to get in just to use a phrase, get in on the ground floor. Get in before it gets overly saturated. Get in while the prices are still reasonable and you can achieve a profit or cash flow. And yeah, it's why not? Yeah, get in on something from the beginning.
That's
It'd
right.
be like knowing about Microsoft stock before it hits. Yeah.
That's
Mhm.
it. Yep, that's absolutely true. Anyway, so here, Elon Musk, right? He has SpaceX. One of the areas that SpaceX is located in South Texas, and a lot of people
Mhm.
don't know. Elon moved his SpaceX and Tesla headquarters to Austin and in South Texas.
Mhm.
That this is his SpaceX launch rocket
Wow.
launch area, which is he called it Starbase. Starbase.
Mm. Mhm.
Elon Musk.
Wow. Mhm. Mhm.
And along with Elon Musk and his vision, there's a lot of supporting high-tech companies are supporting his
Oh,
project.
wow. Yeah. I'm looking at all the royalties,
Yeah,
Starbase, base camp. Wow.
that's right. They're all located within this region. So
Mhm.
it's more high-tech workers, more space engineers, more
Mhm.
other employees coming into this area to support Elon Musk's vision for space exploration for civilian people.
Amazing.
Yeah.
Amazing. I won't be getting on one of them, but it's nice to know he's out there because that does create an advantage for us as investors.
Yeah, absolutely, absolutely. Yeah, very exciting. So, anyway, again, the blueprint, Julie, and you and I gonna hammer this. Almost every podcast we do, we talk about how new construction, new builds are the best realistic asset class.
Mhm.
Okay,
Absolutely.
we're not gonna go too much in detail, but you read about it. So, the best way to for investors to take advantage of this particular market is by new construction.
Mhm.
Why? Because new construction, better location, your tenant gonna stay rented for 2 or 3 years at any given time, low maintenance costs, low CapEx, not in a flood zone. You're not buying HOAs and condos,
Right.
low insurance costs. And in Texas, there's no state income tax, which is good for people that live here. and landlord friendly sticks, right? You can evict the tenant.
Love that.
Yeah, love that. Yeah. Whenever you see developers and new builders building new homes, you know that the particular market is growing because it's growing into the suburb, into the emerging markets, past growth. All right.
Right. Yes.
Everything is new. Deals, the elementary school, junior high school, or like a brand new school system. Isn't it amazing?
Yes, definitely.
Builders and developers, they're not gonna waste their money to build in a particular area. Everything brand new, new hospital, new colleges, new retail stores, new grocery stores, new school system. If they have not already builders, they already done their research. They,
exactly. That's right. That's right. That's a clue.
that's a big clue. That
it really is. It really is. Yeah, people have done their research, as you said, and they are. Everybody's in it to make money, so they're not going to build a bunch of properties if they don't expect to sell them.
Exactly. So this market is low affordability, entry level homes. Investors, you buying low price with high cash flow. We'll talk about that momentarily. So here are some examples of why the title of this podcast is called Trophy Multi-Unit Market. He's one of the few trophy markets, as you can see, a trophy. And here it is. This is one of the current listings we have with one of our turnkey provider here in South Texas.
Nice.
Look at this. Beautiful, brand new 2-story. Okay, it's a separate structure. This building is fourplex. This another building is another fourplex.
Oh my goodness. You buy them both together, you're set for life.
Oh, you ain't kidding.
Yeah.
What you just said spontaneously is so true. You buy one quad, which is 4 doors, 4 tenants, 4 units, another 4 door, 4 units, 4 doors, and 4 tenants. Multiple streams of income. One unit become vacant, or you still are renting, you're still making cash, you're still not in the red. Look, beautiful construction, builders and developers, they develop this nice multi-unit for investors like us from out of state. So it's this cash cow.
I love that they already have the built-in solar. Yeah, I got little solar patios there. Yeah.
Oh yeah, I mean, this fourplex like a little bit more than 4,000 total square foot. 3-bedroom, 2-bath on each unit. Little bit more than 1,000 square foot. Look, if you buy this kind of fourplex with the way it looks in Northern California, in Bay Area, or in Southern California, where you live, it would be a $3 million trophy in California.
At least, probably more.
However, he's a good catch. However, when investors put 25% down payment, conventional investor loan financing, you are getting not $3 million.
Oh my goodness.
500.
Oh my goodness. That is a steal deal.
That is highway robbery. That is robbing the brink. Illegally speaking, robbing Fort Knox. This is the Fort Knox.
That's an amazing deal.
Look at this. Look at the number. I'm not going to discuss this. Look, 1% rule.
That's amazing.
1%.
That really is unbelievable.
It is 1% rule anywhere in the country except the Midwest. But we're not in a Midwest 100-year-old property. I'm not saying that's bad. But new construction in a high growth market. Already 1% rent value ratio and 8% capitalization rate, 9% cash and cash return, and only 30% total investment on the first year.
Oh my goodness.
Yeah, I'm not. Some of you are thinking, how are we calculating 30% return at the end of the first year as opposed to when you use your money to buy mutual funds or stocks and bonds out there in the Wall Street, you get what, 4 to 5% annual rate. The amount of money for $149,000 down payment, you're getting 30% or total ROI in the first year. Third, fourth, fifth year, it will be compounding beyond 30%. Again, we talk about pro forma in other podcasts. I'm not going to spend too much time on it. You leveraging about 25% down payment, you put 6.2% interest rate.
Wow.
Investment loan. So if a monthly cash flow is a whopping $1,000 after you deduct the mortgage, all your debt service, all the expenses, which is a nice cash flow per month at the first year, almost $13,000 in annual net cash flow. Now,
Wow.
plus your principal reduction by the tenant pay down the loan equal economic benefit, almost $5,000.
Right.
I project 5% appreciation at the end of the first year, which equate to $27,450 of equity growth at the end of the first year. If you add on these three numbers, right, equals 45,000. Oh, I have not the cost segregation and depreciation. Everybody's situation is different, but let's say the tax savings is another 5,000, which is but this software does not have the means to do that. So 45,000 plus 5,000 of tax savings at the end of first year. Talk about maybe 50,000. 50,000
Right.
divided by your initial down payment, 149K, equals 35%
Right.
total investment.
Man, that's incredible.
And
That is incredible.
this math I just done, Julie, is ninth grade math.
Exactly.
For investors, you need to digest. Okay, so some investors are thinking, "Oh, I can get this return in a Midwest market." I'm not saying Midwest market is bad, but in the Midwest market, you find a. In fact, let me do some an apple to apple comparison. I forgot. Say that. I have a solution. So let's say you want to buy a comparable. Oh, before we do that, let's use if you have you and I talk about many podcasts, many episodes recently. You could use your IRA to purchase. If you're going to use your IRA, if you have a $500,000 of IRA, you could use your self-directed IRA to buy this core asset inside.
Yeah.
So with that in mind, at the end of the day, you crunch the numbers, okay? You will get a monthly cash flow.
Oh my goodness.
Tax deferral IRA cash flow monthly, 35.
Right. Wow.
Yep. And
Amazing.
at the rate, full cash IRA or cash offer purchase 12% at the first year, 12%, even without leverage. So that means greater than a historical annual return on the stock market, mutual funds, which is normally like 4 to 6%, right? Without any leverage, or maybe 4%, full cash flow. However, something you talked about, you and I have many podcasts. By the way, if you're watching this video, you click on my YouTube channel, you will find other podcasts that Julie and I did about using IRA, using non-recourse loan to leverage to buy properties, right?
Absolutely.
So as a result, we're not going to talk too much in detail, but needless to say, you can buy 40% down payment with the self-directed IRA with 40% non-recourse loan, and the numbers are pretty good as well. Okay, and I'm not going to discuss a number. Basically, we use a non-recourse loan to leverage against the IRA on this before asset purchase. Instead of buying full cash, you're using $231,000 of your IRA money to buy a 549 value property with the power of leverage. The power of leverage using non-recourse loans, and you still have net cash flow available, tax deferral. It'll go back to your IRA, tax deferral, over time compounding effect. When you're ready to retire in 10, 15, 20 years, this non-recourse loan, initially 329K, will be paid down to almost zero.
Right.
And then when you're ready to retire at 59 and a half, whatever, you could draw the monthly cash flow from your IRA to the tune of the $3,500 without even factor in inflation.
Exactly.
Not to talk too much about this, but knowing you have those three strategies, you can anyway. So let's do an apple to apple comparison. With 549K of a purchase price of a multi-unit, where else in the country you can buy something similar? Let's do apple to apple comparison, shall we?
Okay, sounds good.
Yeah, some of you are thinking, "Oh, Mr. You're overhyping this strategy." No, I'm not. I took the liberty of comparing several in other part of the country. Then you guys out there, when you watching this podcast, decide for yourself. As a matter of fact, I welcome you will make a comment on my YouTube at the bottom on your comment. Please comment below. What do you think? Am I
Right.
doing Apple comparison? Okay.
Right.
Julie, I'm not overhyping this. I'm giving you
No.
factual information. What's out there in the other part of the market? Okay. Julie, you know what I'm talking about. We did
Oh, I know.
podcast
Mhm.
before. So let me go through several markets. Okay. San Antonio, okay, which is a very good market, which is
Mhm.
3 hour north of South Texas. And San Antonio have very good new construction, multi-units. But this duplex, 2 unit, so why should you go to San Antonio, buy a similar purchase price almost, and
Mhm.
only 2 doors? We can get 4 doors in South Texas, 549.
Mhm. Exactly.
Okay, that's one comparison.
Mhm.
I know some of you thinking, oh, bigger pockets and other gurus out there, they promote the Midwest market. We get amazing cash flow, amazing.
Mhm.
On paper is amazing, but
Right.
actuality may or may not be amazing if you take into consideration in this kind of older property, 100 years old. This is
Mhm.
somewhere in Ohio. Doesn't matter, it's part of the Midwest.
Right.
Yeah, this is a 5 units, more with more doors. I understand, even a little bit cheaper. Actually, it's a 7 unit, as you can see.
Mhm.
Now,
Right.
cap rate on paper is higher, of course.
Sure.
It's more than 100-year-old property, which is pretty common in the Midwest. And you get a higher cash flow, higher this and that. But the point is, I don't know. Capital comparison, where would you buy? If you buy in this market, maybe a C class, maybe a D,
Right.
A plus
Yes.
class market, where you get some very highly challenging tenants.
Right.
And
Yes.
and the capital expenditure over time is going to eat up into your cash
Mhm.
pocket. If you have a heater to break down, yeah,
Mhm.
you may spend $10,000 to replace the heater or the electrical system.
Right.
It goes all your great high cash flow.
Mhm.
Go ahead.
Mhm. I was thinking the same thing with the older homes. Obviously, there's a lot more maintenance issues, potential maintenance issues that can pop up. And yeah, then the quality of the tenant as well can make a difference
Mhm.
between having a successful property and not.
Yeah, that's right. On paper, the Midwest multi looks good on
Right.
paper, but when you go through the experience the next 5 to 10 years, you might regret it when you buy in a wrong location, cap X, all those issues that will pop up quite often.
Right. Exactly.
I've seen this kind of thing happen. So let's do a comparison. Okay, Las Vegas. Las Vegas is a fast growing market, very, very fast
Mhm.
growing. There's a 4 unit apartment building, is only 549, exact same price.
Mhm. Mhm.
But upon further research, this quad is built in 1977. We're talking like almost 40 years old. Furthermore, it's located in downtown Las Vegas. Now, I'm not saying downtown Las Vegas is bad, but there is certain section of downtown.
Rough.
All right.
Yes. Mhm.
I don't know whether
Mhm.
you've been there or not. I've been to Las
Mhm.
Vegas a few times,
Yeah.
and
Yeah. It can be rough.
I drove around a vehicle inadvertently to
Mhm.
to a bad part of downtown. It's-
Mhm. I'm looking at the bars on the windows are a dead giveaway.
oh, yes.
Right.
That's right.
Mhm.
Yeah, and you gotta know what you're doing. You gotta know, do your due diligence and buy in a good
Mhm.
market.
Absolutely.
Yeah. And on paper, the returns are very similar than our
Mhm.
trophy quad we talked about in South Texas. But
Right.
upon further research, you will fit in. You guys, by all
Mhm.
means, go there. Go to this address is right here. Physically take a look at this.
Yeah.
Okay.
Mhm. And the nice thing about being an investor is that it really doesn't matter where you buy. You can buy in Vegas, you can buy in Texas, you can buy in Colorado, wherever, because that's what we're able to do. Living in California, we bought in New York, upstate New York. So, like you said, if I could take this 549 versus the Texas 549, I would definitely take the Texas 549.
Yeah, exactly. That's right. And you done well. You buy long distance, you
Mhm.
buy remote, you buy to a nice upstate New York area with our great turnkey provider, and you're doing fine. Some of the people, when they buy in some of these out of state markets in Vegas or Arizona or
Mhm.
Ohio, you got to
Mhm.
surround yourself with a good team. And you have a good rehabber, you got a good inspection,
Mhm.
you got a good property manager. If,
Right.
If your team are not that good, it'll discourage
Right.
investing.
Exactly. Yeah, you're absolutely right.
Yeah.
Hmm.
A couple more apple to apple comparison. This unit in Arizona, in Glendale, not a decent area, not the greatest area either, but for a
Right.
similar price, a little bit higher, 600K, you get a 3-unit, you get a triplex. Uh, uh, by looking at the 4% cap rate, you know this property is not going to cash flow that well.
Yeah. Good point.
A low cap rate, I can automatically
Mhm.
tell that it's not the cash flow as well. We talk about 1% rule. 1% multiply that purchase price equals your gross monthly rent. That's the
Right.
mark. But at 4% cap rate, you know what's you're going to have 0.5% rent to value ratio.
Mhm.
This property, 600 grand, 3 units. So each unit will probably rent for like, $1,300. You're not going to cash
Yeah. So you're not getting cash flow on that.
exactly at 25%
Mhm.
down payment. You may cash flow at 50% down payment on this old property, which is probably 50-year-old, most likely C-class neighborhood by the looks of it, right?
Correct.
It's old 50-year-old. I don't know. If it's only a 3-unit, it's not a 4-unit like the one our property. And
Mhm.
couple of more. This one, where is this place? Phoenix, Arizona, same thing.
Oh, okay.
525K. You're not getting
Right.
you're getting a duplex.
2 units. Oh my goodness.
Yeah, this is pretty decent. Okay, I want a 6.27% cap rate.
Mhm.
The cash flow is not as high as the one in South Texas we're promoting. But hey, for 540, 29, it's older, maybe 40 years old, not that old, probably a C plus back neighborhood here in
Right.
Phoenix, Arizona. But hey, why pay this much for 2 unit when you pay 549K for 4 unit, brand
Correct.
new?
Correct. Yes, absolutely.
And here's a kicker. People doesn't know that, but here's the potential situation. 1 to 4 unit, single family home, duplex, triplex to fourplex. You can make the argument, the one that we're promoting, in South Texas, the brand new one,
Mhm.
is an A-class building, right? And
Absolutely.
B to B plus class tenant quality, all right? If you buy a 4-unit a duplex in a B class or C class neighborhood, like we use an example on the prior slides, we're talking
Mhm.
potential maintenance of 10 to 13%, right? And
Mhm.
vacancy of 10, double-digit potential vacancy, 10 to 13%, if it's a B or C class.
Yes.
Now, for some people were thinking, oh, I want to buy 5 unit at a high catching property in the Midwest. Guess what? Okay, you're talking. Look at this. Look at the C class, right? Many of
Right.
the unit in the Midwest, cheap
Mhm.
5-unit, multi-unit buildings. Look at this. Look at the maintenance issue.
Right.
Percent maintenance factor on a C class property, 5 unit,
Yeah.
and
That's high.
vacancy 13%.
Yeah.
You want to buy brand new construction quad in a fast growing neighborhood like the one in South Texas,
Mhm.
in an A class asset class, lowest maintenance, lowest vacancy. That's what I'm trying to. Let me see what else. And I think we're almost concluding. No, that's more. the the beauty of buying 1 to 4 unit, brand new in an emerging market over time.
Mhm.
Yeah, this is a track record we have experience with the markets that we promoting for the past 20 years. Look,
Mm.
if you have the commitment and dedication to buy 1, 2, or 3, 4 properties, let's say year
Mhm.
one, you buy 1 4plex, 1 duplex, brand new, couple single
Right.
family home, and total market value 1.2 million. Okay,
Yes, that makes sense. Mhm.
at 25% down payment. So when you buy a
Sure.
portfolio of homes, I'm not saying everybody could do that. You got to have the capital. We're not going to say you can buy.
Sure.
You can buy several. If you have the money, you can buy several properties to build up your portfolio. So maximum 1.2, 100K fourplex, 300K duplex, and $200,000 single family home equal 1.2 market value year one. Okay. So for those of you are able to buy after 5 years, that's where you really see the light at the end of the tunnel. Right? Number one, you gotta pull the trigger, buy one rental at a time, 1 or 2 at a time in the next few years.
Right.
This 1.2 million of market value is a 3, 4, 5 rentals, a combination of single family home, duplex,
Mhm.
right? This is a benchmark. I'm just trying to show people the example.
Sure.
If able to do that, have the commitment, dedication to do that, and overcome any challenges for the next 5 years. This is the trigger point.
Wow.
The first 5 years, most of you going to struggle. You're going to see vacancy. You're going to see upkeep. You're going to see stress. A lot of people quit. As Julie, you and I talked about it.
Yes.
People buy 1 or 2 rental after 1 year, or they can't take it anymore. Oh, they couldn't take it, become a landlord, right? They don't buy anymore. They're done. How can people, if you can survive the first 5 years,
Right.
you are onto something. You're what I mean by that. In fact, let me lower this. So in 5 years, based on 5% appreciation, the value of your portfolio increased from 1.2 to, let's say, 1.7. Okay, it's just and
Sure.
many of our investors for the past 20 years I've been consulting with, they've done that. Let's see the benefit of investing long term.
Right.
So the renters, all your high quality tenants, going to pay down your loan systematically year over year, right? Your loan balance at the beginning is 7.9K, 45% down payment, right? The loan to value ratio at the beginning, right? Makes sense? Over time, the tenant going to pay down the loan. At the end of the 5th year, your loan will decrease from 729 to 674, right?
Right.
Very simple math. Everybody pay attention. So right off the bat, you have equity at the end of the first year is already 537 and 5% appreciation, 3 to 5%. So your equity could grow systematically on all your rentals year over year, assuming there's some downturns a little bit, like we've seen recently in some markets. But your value keep going up, appreciation. Your loan balance keep coming down systematically, little by little.
Right.
Equity continue to go up. Your loan to value, your equity continue to go up from 537K all the way down to a little bit more than $1 million.
Yes.
And then
Wow.
you begin with an LTV, loan to value, 57%.
Right.
The decreasing of the loan to value every time your loan gets paid down by the tenant.
There you go.
Equity improve. And we're not even talking about the rental income. The rental income component is not part of this formula. But if you can get 3 to 5% rental increase in alignment with the inflation, your cash and your passive income will continue to rise as well, right?
Correct.
Here's the beauty. Okay, I'm not going to spend too much time on this. At the end of the day, at the end of the 5th year, I don't have a crystal ball, but this is based on past 5-year increments of our past investors that have done this over many years.
Right.
At the end of the 5th year, your value goes from 1.2 to 1.7 on your portfolio. Okay, your loan balance decreased from 729 to 674. Your equity have increased from 537 to a little bit more than $1 million. Your LTV have decreased from 57% at the beginning to 39%. Guess what? Then you have this net equity at the end of the 5th year on your real estate portfolio of 3, 4, 5 rentals.
Nice.
From 2018.
Right.
Julie, you are experiencing with your own real estate portfolio. I bet you
Absolutely.
the rental property that you purchased in Bedford Niagara Falls 3.5 years ago, I would say have increased 30 to 50%, if not more.
I would agree with that. Yeah, I would definitely agree with that.
We have potential, although you may not do to have similar number growth based on the Apple comparison.
Makes sense. Yeah.
So this case study at the end of the 5th year, 618K, guess what we're going to do? Week 5 year, cash out refinance. Cash out refinancing money, tax free. When you do a cash out refinance against the equity of your existing rental property, again, great tax benefit, no event when you cash out refinance. So this money, this massive equity you gain in your portfolio in the past 5 years, guess what? You cash out refinance to buy several more rentals.
That's right. That makes a lot of sense.
Well, when you cash out refinance on your current loan, your current rentals, you will not cash flow as much as before, right? Because you are more debt on your loan. So that's fine. Your current rental, which you did the cash out refinance, may even come down to a break-even cash flow, which is
exactly
which is fine because you're leveraging the equity to buy more rental. You're scaling your rental portfolio, right?
That makes sense. Yeah, it makes a lot of sense.
For the rental, you catch a refinance from because you're incurring a higher monthly debt. Hopefully break even, that's fine. But you're able to leverage for several more rentals, 3, 4, 5 more. That's how you raise your rental portfolio over time.
Right, right.
Yeah, you have to do the numbers. You have to have proper cash reserve. You have to consult your investment loan agent. Crunch the numbers, right?
Yes, absolutely.
You can't do it yourself. You have to surround yourself with a team of financial professionals, your coach, your mentor, such as myself,
Sure.
your tax professional, your investment loan agent, your asset protection attorney, your investment loan realtor team. They will help you strategize. Okay. You gotta survive the first 5 years. The
Exactly. That's right.
it's not going to be pretty. You can go through so many challenges. So,
Yes.
Julie?
Yeah, you're right. No, I agree. But you got to hang in there. You can't look at this as a short term venture because you're not going to see the fruit in 1 or 2 years. But yeah, when you stay the course, even using your example, 5 years is still relatively short term, but you can see the potential benefit for just even holding it for 5 years.
Wait, there's more, Julie. If you can survive for another 10 to 15 years, you can repeat this process, refinance, and to buy more units, to leverage into more units. It's the wealth building compounding effect. My goodness.
Yes, absolutely.
And okay, I think I beat it to the death. I'm gonna make this 10-minute module into another separate module.
Okay.
But at the end of the day, as you can see right here, rental property is a great 4 dimensions. You're now looking cash flow. Cash flow at the beginning may not be all that impressive, but you're not
right.
Cash flow. You're buying for equity appreciation. That is the tremendous wealth building potential.
Right.
Equity growth. The cash flow is just maintain the portfolio.
Yes.
Anyway,
tip of the iceberg. No, the cash flow is the tip of the iceberg, and all the other benefits are below sea level. Yeah.
Yep, that's right. And then, as a matter of fact,
oh, there you go. Sure.
Good, Julie. Explain this a little bit more to the audience.
Right, like we just said, the income or the cash flow is the tip of the iceberg, and that typically is what people look at when they're looking to buy an investment property, because of course everybody wants to make money, right? But then you do have the appreciation. Again, what I've found is like the more cash flow you have, the appreciation is a little bit less. But if you have a high appreciation area, then the cash flow is a little bit less. But either way, you're going to do well depending on where you buy. But then you get into the long-term benefits, the tax depreciation, the tax benefits. And a lot of investors, most investors do understand that there are behind-the-scenes benefits too, which as far as the tax benefits. Being able to leverage it with a 30-year mortgage allows you to buy more. So that's what we were able to do with the limited assets that we had. We leveraged 4 of our properties, which allowed it just increased our overall asset. And of course, the equity growth by paying down the principal. And as you showed in the earlier video, doing that over 5 years with the right property in the right scenario, you could actually be able to take the equity out and then redo it again, rinse and repeat, so to speak.
Yep. Rinse and repeat. I like that word.
Exactly.
Yeah. So at the end of the day, you buy long distance, you buy remotely, you buy turnkey, new construction, cash flow rental, at 20 to 25% down payment, and surround yourself with a great team, property managers and everybody else in that particular market. So that's the key, right? Your property managers and team on the ground in the local market will make or break your real estate investing long term.
Absolutely. We've got a great team that we work with up in the Buffalo Niagara Falls area. Just like I said, it takes all the worry out of being an investor.
Absolutely, Julie. You have a great portfolio. You're making money while you and Mark are sleeping.
Yeah, absolutely. I love that.
And at the end of the day, look, people think if you want to buy 100% passive investment, you have to buy mutual funds. You have to buy syndication where everybody do all the work for you. You have to buy stocks and bonds. That's 100% passive. How about the strategies we just discussed, yeah,
Uh-huh.
will be dare to say is 99% passive?
I would definitely say 99% passive. Yes. Yeah. Yeah.
And that,
Just a little bit of work that I do, like you've got up here, 1 to 2 hours per month. And I love that you underline per month, not per week or per day. Yeah. That's 99% passive.
yep, that's right. And 1 to 2 hours per month,
Mhm.
whether you have 6 rentals, 10 rentals,
Absolutely.
or 15 or 20 out of state, long distance, remote,
Mhm.
cash flow, turnkey properties,
Mhm.
are managed by a great team. You compete
Yes.
a almost 100% passive investor. So
Right.
you're able, Julie, from your perspective, if you're able to achieve a great risk portfolio over time, 5, 10, 15 years,
Mhm.
99% passive, you're not trading time for dollar.
Yes.
What is your vision? How would that help you in terms of how you do your
Just life, quality of life is really what it is. Like I said, you have this passive income coming in that you know is going to consistently come in. You've got a great team working behind you. So you know that you don't have to worry if something breaks or something or a tenant moves or whatever. You don't have to worry about it because you know someone's going to handle it. So then it frees you up to do the things you really want to do. Like my husband and I like to travel, and we haven't done it as much as we would like to, but that was part of the goal of buying the property. We'll have this income coming in along with our other income that we'll have through retirement and whatnot. And we can just live life and not worry about what's going on with my property.
Yeah, by having a financial freedom portfolio, by having passive income, allow you the freedom to live your life on your own terms.
Oh, I like that. Yeah. Mm-hmm.
You control everything. You're not dictated by the economy. You're not dictated
Right.
by all the negativity out there. You
Right.
have a stabilized portfolio that will allow you the financial freedom to do whatever you want, traveling,
Mhm.
take care of your community members at your
Yes.
church.
Absolutely. Yes. We're very involved with our church. Yes. So,
Yeah, that's the whole idea to buy real estate portfolio, not to actively self-manage your portfolio or do all this weird stuff, fix and flip and do this, managing all this crazy trading time for dollar. That's not my cup of tea. All
right. Right.
right. All right.
This has been great.
Yeah, with that said, we pretty much conclude this presentation. And you guys out there, if you receive any value whatsoever from this content, please like and subscribe to my YouTube channel, and also put your email down on my website below so you can become a free member of our investment community. And then you'll receive consistent daily email newsletters into your email inbox. You can learn more about real estate investing, free education, and everything else. Thank you so much.
Thank you.
Have a nice day, Julie.
You too. Thank you. Bye bye.